Welcome back to Bitcoin Treasuries. I'm Tim Kotzman here with Joe Consorti. Joe, thanks for being here. Thanks for taking the time. How's it going?
Going well, Tim. Thanks for having me. We chatted a little while ago. Thanks for having me on your show. I'm excited to chop it up again.
Absolutely. You're known for your analysis of Bitcoin, particularly around macroeconomics, market liquidity, institutional adoption. And you often analyze Bitcoin through a liquidity lens. How do you see global liquidity cycles impacting Bitcoin's price action, both in 2025 and beyond?
For sure. So basically, since September of 2023, and I'll actually back it up. Bitcoin's monetary properties, you and I both know, it allows it to be the apex hedge against monetary debasement, money printing, right? And that's something that needs to happen in order to keep the system afloat. Right now, we have something like 36 coming on $37 trillion of debt. We're running a 7.5% annual federal deficit relative to GDP. And so, the marginal buyers of U.S. Treasuries are becoming fewer and farther between. Obviously, U.S. Treasuries, our government debt is the most sought after in the world. But the unfortunate reality is the situation we find ourselves in makes it increasingly unattractive because we have to increase issuance. The marginal buyer of that debt has to increasingly be the Federal Reserve, and they buy our treasuries with printed money. And so that's the situation we're in. It's becoming worse at an accelerating rate, meaning we're having to print more money more often in order to buy more of these treasuries. And I believe the Fed is going to have to take a more active role in these auctions if we are going to, continue sustaining the current size of the U.S. government and the 36 to $37 trillion debt load we have. And so it's a certainty that money is going to get printed. That's just a certainty. It's not a question anymore. Maybe in 2002, when we ran our last surplus ever, when I was 1 year old, maybe it was a possibility that, once again, we would find our way out of this situation. But it's just a reality that we're going to have to print more money to buy more of our sovereign debt to make, this entire system continue to work and function. And so to that end, Bitcoin was created to serve as a hedge against that, right? It's no secret, it's no coincidence that Bitcoin being birthed out of the aftermath of the 2008 financial crisis was very poetic. It was poetic in the sense that, okay, they continue to engineer, create these financial crises and bail out all of their friends with massive amounts of money printing. The gap between asset owners and the have-nots is increasing, right? If you own assets, you have had the best 17 years of your life. If you don't own assets, if you don't own a home, if you're not paying a mortgage, chances are you have not had the best 17 years of your life. And people who are now just exiting places like high school and college, getting into the workforce, potentially thinking about starting a family, potentially thinking about buying a home. These are all situations that I'm in now. And people are feeling increasingly nihilistic toward those prospects, right? But Bitcoin emerged out of the great financial crisis as a method for people to insulate themselves from the fiscal and monetary fallout of every single time there's a crisis. Because every time there's a crisis, they print money. You can own assets, but all of those assets can be inflated away. The reality is shares of stocks in the S&P 500, more of those get issues when the price is doing very well. You have places like shops like NVIDIA who had a absolutely banner 2023, just issue more shares. Even with harder commodities like gold, when its price rises, you can go get more gold, right? When its price rises, it gives the miners and these other companies more capital to invest in their operations, go find new gold, get more machinery, hire more manpower. And ultimately, that's a supply response that drives down the price of the good. Bitcoin doesn't have that. It does not have a supply response. And therefore, every single model is broken. My colleague and I, Nick, over at the Bitcoin Layer, have spoken about this many times. Satoshi completely broke economics with the fact that Bitcoin has no supply response whatsoever. And so given that there's no supply response, it has this monetary policy, which is absolutely fixed and immutable for the rest of time. It's really the best asset that's ever been discovered to hedge against this monetary debasement. And so it's going to go up forever as long as this system perpetuates, which it needs to. And so then it becomes a question of where are we going this year and beyond? Well, more recently, the flows coming into Bitcoin have been larger in size. The entities have been growing, right? So we've seen the launch of the ETFs last year in January. Those were obviously, if you combine them all, if you look at them at an individual level, like IBIT on its own, which is the largest ETF operated by BlackRock, it had record-setting inflows. And so for the entire year, that was basically the dynamic. The average, Bitcoin market participant grew in size. It's now these institutions, these passive flows, right? People who are just allocating a portion of their check every week, biweekly, or every month into, their retirement account. Their manager puts it into Bitcoin, or they have the choice to allocate to Bitcoin themselves via these ETFs. And so now we have this structural bid. We have these institutional flows. We have a couple of other things on the horizon, which I'm sure we'll talk about with the repeal of SAB 121, so banks can custody Bitcoin, the change in the FASB accounting rules, so that companies are more driven to allocate to Bitcoin on their balance sheet. So we have all these changes that have happened and are also coming in the works that will drive the average size of the holder to be larger and larger and larger and larger. It's not just retail speculation anymore. It's now some of the largest financial institutions, companies, and governments in the world, the United States included. And so the structural bid is larger. The perpetual bid is larger. But this is also juxtaposed with global liquidity, right? And global liquidity can be defined in two ways. Number one is balance sheet capacity. That factors in the volatility of U.S. Treasuries, the price of U.S. Treasuries, and the issuance of U.S. Treasuries to kind of get a sense of where banks are at with how they lend, right? Because you and I both know money is lent into existence when banks have smaller balance sheet capacity, whether that be for a decline in the price of Treasuries, so yields coming up, or more volatility in the Treasury market. That would drive lending to go down. That would drive money creation to go down. So that's one way of defining liquidity. The other way of defining liquidity, which is more popular, is just money supply, right? Global money supply. Well, actually, both of these definitions of liquidity are expanding right now. Global liquidity, as is defined by this balance sheet capacity, is expanding. Rates are coming down. Treasury volatility, it's picked up a little bit in the last 3 weeks since Trump got into office, but largely it's still pretty muted. Rates are coming down. That means lenders will be more incentivized to lend new money into existence. That's a very good thing for the rest of the year and into 2026. The other aspect of it is M2, global money supply. That's the other definition of global liquidity that's more often used. That too is rising. Not just because banks are expanding the money supply, global central banks, not just the United States, are expanding the money supply, but because of US dollar weakness. So we had a period of tremendous US dollar strength over the, once Trump was elected, actually several months before Trump was elected, around August, September, we had this huge rally in US dollar strength. Now that yields are coming down in the United States and elsewhere, that US dollar strength is threatened, relatively speaking, and it's actually coming back down at the margin. I believe right now, if I check over the last month, it is flat. Actually, I'm not even in my terminal now, but it is flat over the last couple of months, and that's good, right? Because US dollar weakness that drives global M2 denominated in US dollars to rise, right? So global money supply rising, that's good for Bitcoin. The reason I mentioned and the end of my answer is coming up here very soon, I promise. The reason I mentioned the size of these players that are coming into Bitcoin is because it's a sign of the institutionalization of Bitcoin and the heightened importance of global macro factors like the global money supply to Bitcoin's price. So Bitcoin's monetary properties have always allowed it to basically be a proxy for global M2, for the expansion and contraction of the global money supply. But it never really functioned that way, at least on a micro level, right? On a macro level, huge money printing in 2020, massive Bitcoin run up, in 2021. Okay. But it wasn't really micro. It didn't happen kind of to the beat. Now, since September of 2023, for some reason, there was like a 1-to-1 correlation between global M2 denominated in US dollars and the Bitcoin price. That was about 3.5 months, 4 months before the ETFs went live. So now it seems to me this correlation only recently broke. It broke about 4 weeks ago. Global M2 began declining because of US dollar strength. Now it's back on the rise because of US dollar weakness. But during that time, Bitcoin began consolidating instead of falling with global M2. But before that, for about a year and a half, what you saw was Bitcoin rising and falling, ebbing and flowing, basically 1-to-1 with global money supply. And so that tells me that these global macro factors, global liquidity chief among them, have heightened importance to Bitcoin's price because of the financialization of Bitcoin, because of these new cohorts that are coming into the market. And so for me, seeing these two dynamics at play, the fact that US dollar weakness is probably on the table because we have Trump in office. He hates dollar strength. If there's one thing I remember about the Trump presidency, most of the tweets he was putting out were toward Jerome Powell, screaming at him to lower interest rates, which ultimately he got in 2019 after the repo blow up. And so Trump is a businessman. He doesn't like dollar strength. I believe dollar weakness is going to be one of the stories of 2025. And as a result, you pair that with expanding balance sheet capacity because of falling interest rates. And that both of those factors combine for an expanding environment of global balance sheet capacity, global liquidity, and global money supply, all of which are good for Bitcoin. And so, this year I believe is going to be a pretty banner year for Bitcoin. We have not, in my opinion, seen the cycle top yet. I believe if you were to, make a bull case for Bitcoin, you could definitely say Bitcoin probably reaches somewhere around $200,000, if not more than that. Bear case, right? I think we ascend a little bit higher from here. Probably to 125, 150. But the broader picture, which I want audience members to take away, is that now that Bitcoin has so much heightened sensitivity to global M2 specifically, and it's breaking a lot of these cross asset correlations that it had to things like the broader crypto market. These factors matter more than ever. And so I want people to understand that that's the important thing. Bitcoin is finally fulfilling what its monetary properties have always allowed it to. The market price is finally reflecting that. And given that this year, chances are global liquidity is going to expand, Bitcoin's going to have a very, very good year too.
Hey guys, this episode is brought to you by OnRamp. Bitcoin custody is evolving. Both self-custody and single third-party custody come with significant risks and trade-offs. OnRamp is pioneering a new standard, multi-institution custody, which eliminates single points of failure, adding fault tolerance and redundancy to your setup. OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault, guarded by 3 independent, institutional-grade custodians, none of which have unilateral control. Multi-institution custody removes the technical, mental, and physical burdens of private key management, providing unparalleled peace of mind for you and your loved ones. To learn more, schedule a consultation with the OnRamp team. Go to www.onrampbitcoin.com. You mentioned SAB 121, which has been repealed. So in essence, now banks can actually custody Bitcoin. How do you think about the repeal of SAB 121 along with the strategic Bitcoin reserve and the proposed the proposed sovereign wealth fund that was signed by executive order, and we, I think, don't have a lot of details on yet. Do you have a ranking of which one of those might be first and second in importance as far as the reality of banks custodying, and then both of those vehicles, and or how they would work together potentially?
Yeah, I believe SAB 121, that repeal, is more substantial than a strategic Bitcoin reserve. For a couple of reasons. Obviously, the prospect of nation states buying Bitcoin is extremely lucrative, right? For the average Bitcoin holder, right? For people who own Bitcoin, you and me, and probably most of the audience members included, the idea that the United States with its infinite balance sheet could begin buying Bitcoin is insane. It's an incredible development. It will drive many of the nation states who are considering it to fast track their plans, and these working groups that they're putting together to determine the viability of this. It will fast track those, and it will drive this global arms race toward purchasing as much Bitcoin as you can as fast as you can. This is an asset where there are only 21 million units of this, all divisible into 100 million units. And so 21 or 2.1 quadrillion total units. Even still, it's absolutely scarce. You want to own as much of that as you can. The United States owns about 207,000 Bitcoin. So, right around closing it on 1% of the supply. And so it's in the United States' best interest to expand that, to not solely own, and to expand those holdings as quickly as we can. Given that money printing is an inevitability, this will insulate not just the United States from this US dollar debasement, but what it will allow the US to do is later on down the line, 10 years, 20 years, 30 years from now, have a chance at meaningfully tackling our debt problem. I love Doge. I love the idea of Doge. But the reality is right now they're moving at a clip of, $10 to $100 million in cuts a day. We have $36 trillion worth of debt. Our deficit is something like 1.6, $1.9 trillion. In order to actually tackle the deficit of $1.9 trillion, we'll call it, they would need to be moving at a clip that's like 10 times, 100 times, 200 times as fast as they are now. And so they're going to cut government waste, but they aren't going to do it to meaningfully tackle the deficit, right? People will be fired from their jobs. The USAID guys will go cry about how they can no longer, send millions of dollars to Botswana to funnel it through a shell company they have over there and buy a third house. But it's not going to tackle the deficit in any meaningful way. What we do have a chance to do to tackle the deficit is allocate to Bitcoin as quickly as possible in size, because Bitcoin right now is looking at the price over my shoulder, it's around like a $1.94 trillion asset right now, which is roughly the size of the deficit. If we can increase our holdings from, right now they're 1%, let's say we move them up to 5%, which is the plan for the Bitcoin Act of 2024. Senator Lummis's plan that she put forward, and she's now working with other people to put it through Congress, is to purchase 1 million Bitcoin over a period of 5 years. That would raise our total Bitcoin holdings from 200,000 to 1.2 million. That would mean we own over 5% or roughly 5% of the outstanding Bitcoin supply. That would be a substantial development. That would make it so that instead of holding this, it's not diminutive in any sense of the word. It's still 1% of the supply, but it's certainly not enough within like a 10-year, 20-year, 30-year time period to potentially like meaningfully take down the deficit. But by doing the Bitcoin Act of 2024, it will spark other countries to do the same. It will allow us to increase our holdings, and it will make it so that we could potentially meaningfully tackle the debt over the next several years. The reason why SAB 121 to me is more important is because Bitcoin's price is going to go up regardless of whether or not the US government starts buying it. One major catalyst, and for me, it's just the next logical evolution in Bitcoin's monetization journey, is banks being able to custody Bitcoin, lend against Bitcoin, and create other Bitcoin structured finance products. These are in demand, like highly in demand. People don't know where to buy Bitcoin. They're uncomfortable by the prospect of creating an account on Coinbase, which is something they've never heard of before. River.com easily, in my mind, is the best Bitcoin only exchange. But even still, the greatest on-ramp for Bitcoin would be if you could go to your Chase Bank ATM, put in your debit card, type in your PIN number, and buy Bitcoin into your savings account. That would be the biggest on-ramp for Bitcoin in its history. And it would do two things. Number one, it'd be massive for the financialization of Bitcoin. It would push Bitcoin even further down the risk curve. Because right now, if you plot out, and I wrote a piece about this on Theya Research. If anyone's interested in reading, you can go check it out. Basically, I called it the sudden decline in Bitcoin's risk profile. If you plot every single asset in the known universe on a risk curve, right? 0 being the least risky asset, 10 being the most risky. You'd probably see something like US Treasuries close to 1, then physical gold, then investment grade bonds, then equities, and then at the very top, junk bonds, venture capital, and then even higher than that, lottery tickets, right? Bitcoin right now is probably around a 7 or a 6. Right? Or I would say probably a 5. With the repeal of SAB 121, that immediately dropped Bitcoin's risk profile from a 7, which is like riskier than equities, to a 5 immediately. So less risky than equities, a little bit more risky than investment grade corporate bonds. And the reason being, once banks can hold this thing, and they hold this thing that there can't be any more of it printed, right? It's different than US dollars. It's functionally different than any other collateral type these banks have ever held. It means that Bitcoin is all of a sudden overnight far less risky than those assets. As these financial tools proliferate, as people can borrow against Bitcoin to take out loans, you can get a Bitcoin backed mortgage that's entirely backed by your Bitcoin or backed by your Bitcoin and the property. All these different types of tools, it's going to fundamentally change the way that credit markets work, because Bitcoin is a better form of collateral than US Treasuries. And I could talk about why that is. I'd love to go into why Bitcoin is a pristine collateral. But it will also, because banks are holding this asset that it's very dangerous to rehypothecate, it would make Bitcoin far less risky. And it's dangerous to rehypothecate. It's dangerous to use it as collateral over and over and over and over again, because you can't print more of it, right? If all of a sudden something happens like with Silicon Valley Bank, and all of a sudden people want their money back, and it's discovered that you were rehypothecating the collateral, you were rehypothecating basically all these users' US dollars that were on your balance sheet and US treasuries that were on your balance sheet. All of a sudden, your bank may collapse, but you also can go to the Fed and say, hey, I need US dollars, or I need some kind of loan facility, and they can set it up for you. They can print new US dollars into existence. The same can't be said for Bitcoin, right? You can make customers whole if you get a bank run, your bank collapses. You could make your customers whole by giving them US dollars and the equivalent of their Bitcoin, but you can't give them their Bitcoin back if you lose it, right? If you rehypothecate it, and all of a sudden your bank goes insolvent, you can't recover those lost Bitcoin. And so it becomes a very dangerous business for these banks to rehypothecate this Bitcoin. And so naturally, it makes lending safer. These people will want to use Bitcoin as a preferred form of collateral over US treasuries for several reasons: for its verifiability, for its scarcity, for its 24/7, 365 settlement. You could see where it's going. You could see who owns it. It can make for a far more transparent lending structure. And also, if somebody can't, increase their collateral, right? If their, loan value falls and they need to post more collateral, they can't do it. You could liquidate the loan immediately, right? You could liquidate the borrower, and then you could take that collateral. It's far more preferable than US treasuries for that very reason. You can't do it 24/7, 365 in an overnight fashion, instantly, globally. But you can do that with Bitcoin. And so it's going to become a far more widely used form of collateral. But in doing so, because it's so risky to rehypothecate, so to use this collateral over and over and over and over again, it's going to make it so that loans naturally become better. Lending becomes safer. The quality of credit becomes better. And so for me, that's the bigger development than a strategic Bitcoin reserve, because it will better the world around us, but it's also, it's massive for adoption, right? It's massive for adoption. It will better the world around us. It will increase the quality of credit that's being extended to people. It will make people think twice about whether or not it's worthwhile to take a loan out on your Bitcoin because it's so valuable. And for me, that is a far more substantial development than the prospect of a strategic Bitcoin reserve. That's kind of the sleeper announcement that went under the radar, that did not have as big of a price pop after the news as I expected it to be.
Mm-hmm. Do these three items, the SBR, the sovereign wealth fund, the repeal, where banks can now custody, does that do anything to your 2025 without getting into price predictions, like your price prediction of 125, 150, 200,000? Like, would those potentially accelerate, or you think it'll be kind of a slow grind up, even if some of these announcements, you get a pop on the announcement, but it's just, it's going to take quarter over quarter, year after year to kind of actually get where we're going from a supply, demand, price perspective?
That's it. That's a fantastic question. And this lets me get into a little bit of my thinking as it pertains to markets. So every single Bitcoin cycle, right, we have these price predictions, but ultimately the way that these cycle tops realize themselves is by the developments native to Bitcoin that happen, during those cycles. So during the 2021 cycle, Bitcoin didn't reach $64,000 independent of a massive amount of fiscal and monetary stimulus. It reached $64,000 because of that. And so when we're looking at cycles and saying, okay, my price target for this cycle, given diminishing returns of the last three cycles, is going to be between 150 and 200. That factors in any kind of development that could happen in between during that cycle. And so for me, it's always something different every cycle, but invariably there's something really positive that happens for Bitcoin's monetization, its adoption during that time frame that allows it to reach that price. And so for me, it doesn't necessarily believe we'll get there faster or we'll go higher, right, than what I believe we're going to end up at, right, somewhere between 150 and 200. But it's kind of it's the event of this cycle that leads me to believe we'll get there, right? It's different every cycle. In 2017, it was the rise of alts, the rise of derivatives, CME Bitcoin futures being put live. it was all of those factors in confluence with one another that let Bitcoin go from, $1,000, $3,000 to $20,000. In 2020, 2021, it was this massive, huge print that allowed us to get where we were going. And then in the bear market, it was exchanges like FTX, Celsius, Voyager, Genesis, BlockFi. I may have missed a couple that collapsed that led us to go to the bear market. So there are always these Bitcoin native factors and global macro factors that drive Bitcoin to reach a certain price during the bull market and during the bear market. This time around, I believe it's largely those three things, right? The continued institutionalization of Bitcoin, which includes the repeal of SAB 121, and these other geopolitical factors like the sovereign wealth fund and the strategic Bitcoin reserve, paired with this massive structural bid that we're always going to be getting for the rest of time, from passive flows from pension funds and retirees contributing to their retirement accounts and things like that. Those are all the factors that lead me to believe we're going to get to those heights, right? Because you can't reach those heights without buyers. As these new buyers come online, as these new methods of using Bitcoin come online, as these accounting rules get repealed, so companies, CFOs are more driven to allocate to Bitcoin in size in their balance sheets. As these things happen, these are the developments I'm looking for that lead me to believe, all right, we're going to reach these targets. We're going to reach somewhere between 150 to 200 this cycle. It could very well accelerate that path, right? Within 180 days, David Sachs' working group could come out and say, okay, we've determined that a strategic Bitcoin reserve is in fact viable. We are going to be working jointly with Senator Cynthia Lummis in order to establish the Bitcoin Act of 2024 so we can allocate to Bitcoin over the next 5 years. We can purchase 1 million Bitcoin over the next 5 years. The race is on, right? If that happens, you're going to see a $10,000 price candle, right? So it certainly would accelerate, depending on how these things play out, it may very well accelerate our ascent to those targets. But in my mind, just the probabilistic way of thinking of things and the very zoomed out way of thinking of things, I just view these as the Bitcoin native and macro developments of this cycle that are going to let us reach that target in a stepwise fashion. Where Bitcoin's at $100,000 and people are really upset. And they're really upset because Bitcoin's boring now. That's the reason you see people going to all these altcoins and these casinos and all this other stuff, kind of this financial nihilism. Because even though Bitcoin is an asset that's growing with like a 30 to 40% 4-year compound annual growth rate, people are still greedy and they still view it as boring. And they view it as boring because Bitcoin's market structure has changed. It's now no longer the bucket shop where everybody kicks around some leverage and hopes to win big. Those roles have now been overtaken by crypto and MSTR options, at least in the summer of last year. Those have cooled down now. Sports betting apps, gambling, those are now taking the place that Bitcoin kind of was the king of during 2017 all the way through 2020. Now Bitcoin is so large and it's so stable. It's been hovering at $100,000 since November, or since early December. And so we've been here for 3 months. Bitcoin is getting boring. You can't trade that. And so people are looking to other things because Bitcoin's market structure has fundamentally changed. The way its price behaves has fundamentally changed. So my base case is that we're going to reach these levels as a result of all these Bitcoin native and macro developments, but we're probably going to do it in this stepwise fashion, right? We bottomed at 15, we stepped up to 25, spent several weeks there, stepped up to 30, spent several weeks there, then 40, spent several weeks there, to 74, spent 8 months there, and then we exploded to 100, and now we've spent 3 months there. We could hang out here for a very long time before we make the next ascent higher. But ultimately, for me, that's a good thing. It means that Bitcoin cycles of the past, where you see an 80%, 70%, 65% drawdown, those are likely things of the past, because now Bitcoin is more spot driven and all this leverage, all this speculation has migrated to these other more volatile instruments.
The Bitcoin for Corporations Conference is coming to Orlando May 6th and 7th. Receive 20% off admission by going to microstrategy.com, selecting Bitcoin for Corporations, and using discount code KOTZ at checkout, and I'll see you there. Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. You mentioned on the topic of Bitcoin being custodied by banks, being able to go to Chase, JP Morgan, and have your Bitcoin savings account, so to speak. Do you think that that will kind of drive the volume from a retail perspective of net new holders of Bitcoin versus some other solution? And would there have to be some sort of blow up similar to last cycle with FTX, et cetera, that you mentioned in order for people to like in mass kind of consider some sort of other solution, like a multi-institutional solution? Because you have, like you mentioned, right, like River and Swan and OnRamp and all of these kind of other Bitcoin only solutions, but like does the money just kind of go straight to the bank, no pun intended? Or how do you think about that, along with just the like there's just not a lot of Bitcoin companies? Is it because the companies like, or the space can't support more at this point? And do you see that evolving and changing in the future, whether it's custody solutions or like level 2, level 3, layer 2, layer 3 rather, right? Lightning Network sort of, or other apps, or any thoughts or insights into those areas?
Absolutely. So I believe that being able to go buy Bitcoin, at your Chase ATM, at your Citizens ATM, whatever bank, large and small, right, regional and national you've got, that's going to drive an entirely new class of retail investors into Bitcoin. But those retail investors are not going to be speculators. They're going to be very similar to the structured bid you're seeing from retail via the ETFs. They're going to be very similar to those. People who were formerly Bitcoin agnostic that now see I can allocate to this in my savings account. It must be very safe if Chase Bank is letting me do this. And so it's going to be a massive class of retail investors who are not here for speculative explosions, but they're here for long-term savings. So that's going to be big. That's going to be a huge development. But what it will also do is it will drive some banks, because Bitcoin rehypothecation is not banned yet, and I believe it should be. It will drive some banks to play around with customers' funds, do a similar thing to what FTX did, accept customer deposits, take them out of circulation, go gamble with them, and ultimately lose customer funds. And it may not be discovered until several months or years later when a bank run occurs, when people try to withdraw their Bitcoin. You can't do it instantly, which is what Bitcoin allows you to do. All of a sudden, it creates a massive panic. And then overnight, it's determined that bank was playing bad baseball with customers' Bitcoin. I do think there's a huge risk of that happening, just like what happened with FTX. Because ultimately, what happens when you create this new financial product, this exotic financial product, banks love to play games. And one thing banks are used to doing is getting a bailout from the Fed. But that bailout from the Fed always comes in US dollars. There's no central entity that will be able to print more Bitcoin in a time of crisis. If you lose your Bitcoin, it's probably gone forever. And so either rehypothecation gets banned before any of this other stuff happens, Bitcoin rehypothecation specifically, or what has to happen is an explosion similar to FTX, or in TradFi similar to Silicon Valley Bank, before people start to become more averse to these solutions. I believe that in either case, what it will do is it will drive these banks to adopt a formal proof of reserves framework, similar to River.com, right? River.com is, and I'm not sponsored by them at all. I just love the exchange and I love speaking about, their great practices. They have a proof of reserve system where you could go in every single month on a monthly basis and check out their assets and their liabilities. And you can see that they have more assets than they have liabilities. That will become standard for banks who begin using Bitcoin. Customers will begin demanding it, either as they learn more about Bitcoin and they understand that, hey, if you're not holding this, it's somewhere else. I want my Bitcoin back from you guys. It will become standard one way or another, and it will drive the risk associated with banking on Bitcoin lower. But if banks don't play a ball and you have a series of these explosions, what it will do is it will drive a lot of that retail capital into these Bitcoin only exchanges with proof of reserves like River, right? It will drive customers who may have bought Bitcoin at Chase, but then, JP Morgan got caught with his pants down rehypothecating customers' Bitcoin. I'm going to get my Bitcoin out of Chase because they don't have proof of reserves. I don't feel comfortable here. I'm going to move my money into River, right? Or some other Bitcoin only exchange that has proof of reserves. So I believe that it's going to drive two things, right? It might cause a blow up because of human greed and the tendencies of bankers to believe that the Fed's going to bail them out. There will be a hard lesson learned when they realize that there's no central bank on Bitcoin that can create more for them to make them whole and make their customers whole. And it will also drive banks to adopt a proof of reserves framework. As a result, it will become industry standard, and it will drive capital into Bitcoin only exchanges that do provide proof of reserves. The other thing that it will do is it will create, it will drive people into self-custody solutions, right? Whether it's multi-institutional, like on-ramp, as you just mentioned, whether you are a business and you are banking with Chase, it will drive people to River's business product or to Acropolis, right? Their Bitcoin treasury solution, or Theya, right? Our either retail multi-sig self-custody solution or our business multi-sig self-custody solution. It will drive more people to these products. With or without some kind of banking accident. And that's really a beautiful thing. Ultimately, once people get into Bitcoin and they see what its price does, or they just want to learn more about what it does, they're compelled to go down the rabbit hole, right? As you did, Tim, as I did, right? Once you own a little bit of this thing, you want to learn more about it. And so naturally, what that will do is it will drive people to Bitcoin only exchanges. And then it will drive people to self-custody. And then it will drive people to a multi-sig solution of their choice, right? Whether it's Theya for retail or businesses or advisors, or on-ramp or Unchained or Casa or Acropolis or Sovereign. One of these great, retail or business self-custody solutions, it will drive people to hardware devices. It will drive people to, working with Bitcoin native financial advisors like Strongwealth, like the Bitcoin Advisor. That's what it will do. And so for me, even though I know for a fact there's going to be several scandals over the next several years, I believe banks will be forced to learn their lesson the hard way because there's no Fed that can bail them out with printing Bitcoin to make their balance sheet whole again. And what that will ultimately do is it will christen this whole new class of retail Bitcoiners and institutional Bitcoiners and businesses who want to hold it on their balance sheet to become seasoned Bitcoin professionals who self-custody, who use any number of these services as I just named. That's what I believe ultimately these developments will lead to. I have no doubt that the greed of bankers will drive some kind of crisis, but I believe the nature of Bitcoin will make it so they learn very quickly and they're forced to change their ways lest they lose all of these customers to a place like River or to a self-custody solution.
Yeah, it's interesting. I recently heard someone say to me, look, some of these banks are just like FTX. They just wear nicer suits. And that kind of hit me. I was like, huh. Even now, it's so ingrained in me that just keep picking on JP Morgan for an easy example, right? It's like, well, they're too big to fail. And then the conversation of, well, exactly what you said, right? They're too big to fail for fiat, but not for Bitcoin because you can't just print more. So it's just all very kind of basic and fundamental, but until it really hits you between the eyeballs, I feel like a lot of what we're doing is, saying the same thing or different things and talking through different viewpoints of orange coin good, but until the right person with the right voice at the right time kind of says it and someone hears it, they're like, oh, now, right, kind of resonates through different people and the different ways that people learn. So it's interesting. Do you, I know you mentioned Bitcoin as pristine collateral. Like why is it pristine collateral and what does that mean moving forward? Like this morning I saw Punter Jeff, right, responding to like a Wall Street Journal analyst that was, I'm surmised was going on a rant or at least a topic in an interview about, MSTR should not be valued at more than 1 times their Bitcoin holdings and, just kind of not seeing some of the fundamental elements and certainly not seeing where this could go.
Yeah. So Bitcoin is pristine collateral. essentially what I mean by this, collateral, right? The most widely used form of collateral, right, when writing loans is U.S. Treasuries, because they're colloquially considered risk-free. They're considered risk-free because the U.S. government has this massive money printer. No matter what, you know that your payments are going to come in on U.S. Treasuries, right? You know that the United States is not going to default on any of its loans. The reason we shut down the government is so that we can continue these payments on U.S. Treasuries, these coupon payments without stopping coupon payments and defaulting on them. That's the reason the government shuts down. That's how risk-free treasuries are considered. The U.S. government is willing to shut itself down. The only problem is that treasuries have several risks that don't make them a very suitable foundation for credit markets. The reason that the system we're in has become such a problem is because they are allowed, the U.S. government is allowed to inflate away the denominator, right, of the coupon payments you're receiving. Our interest expense has become such a massive problem. It's now the second biggest line item on our balance sheet, second to Social Security and Medicare. It's now bigger than the defense budget. And because it's such a big problem, what we've done is we have allowed price inflation, true price inflation, not CPI, but monetary debasement, to run hotter annually than interest rates. And what that lets us do is pay these coupons back in a currency that is worth less. So treasuries have all these risks. They have duration risk, they have inflation risk, they have counterparty risk with the U.S. government, because ultimately they are a counterparty and they can default. And all of these have been magnified over the last 3 years since COVID. Well, 4 years, 5 years since COVID. Look at how the time flies. And so this is called the U.S. debt spiral. Ultimately, we need to increase the issuance of these treasuries. More of that needs to be purchased by the Fed with printed money. And that is a spiral that accelerates down. And with interest rates remaining elevated, that is a crisis for the U.S. government, because it means now our annual interest expense is over $2 trillion. By the end of this year, if rates stay where they are, it will be $2.5 trillion in annual interest expense. And so as these things happen, the structural flaws in this system become very, very clear. Banks and financial institutions are increasingly looking for alternative forms of collateral that are more risk-free. And so why I say pristine collateral is because it offers all these attributes that U.S. Treasuries fall short in. Basically, collateral that banks are looking for are liquid and relatively scarce and free from counterparty risk. Bitcoin is very uniquely suited with its monetary properties to step into that role. And again, I'll go back to Bitcoin's monetary properties because that's the shift that the market is now pricing in. For example, Bitcoin dominance is at 64% during a bull market. That's never happened before. It's rising. Crypto is exploding. And that's because the market is coming around to this reality that theoretically, Bitcoin could serve as collateral on par with gold and U.S. Treasuries. It could be a bona fide reserve asset on par with those two things. And that's also why David Sachs had mentioned in Trump's executive order, the working group he put together was going to explore the viability of a national digital asset stockpile. Now, David Sachs came up on stage. He didn't mention digital asset stockpile once. He called it a strategic Bitcoin reserve. So that's a massive shift. And that's an understanding that Bitcoin is the only viable potential reserve alternative to gold and U.S. Treasuries. And that's because it's highly liquid, right? It's a $2 trillion market. Ultimately, it is on the path to usurp gold at $20 trillion. And then you're just a stone's throw away from the U.S. Treasury market at 30, 35 trillion bucks, right? So it's liquid. It's monetizing, so it's going to be even more liquid. It's instantly verifiable, right? You can verify who owns it and how much of it they own. It's bearer owned, right? And by doing that, you eliminate counterparty risk, right? Posting U.S. Treasuries as collateral, your counterparty isn't the person giving them to you. Your counterparty is the U.S. government. But gold and Bitcoin are both bearer owned. And again, unencumbered by counterparty risk if the bearer owns it, if it is self-custody. The one big thing that was in the way of all of this, which I mentioned, was SAP 121. Now that's gone. And so these regulatory restrictions that stopped banks from fully integrating Bitcoin into lending markets are gone. And so as banks begin using Bitcoin as a form of collateral, it's going to have a massively profound impact, right? Um, Overall issuance will be improved because these loans are going to be secured against an asset that can't be inflated away, or defaulted on, like U.S. Treasuries, which we're not at risk of, and so we choose to deflate it away, inflate it away. You can't do that with Bitcoin, or manipulate it through changes in monetary policy, which you can do with the Federal Reserve raising and lowering interest rates. If they lower interest rates, right, or they raise interest rates rather, all of a sudden, your U.S. Treasury, let's say you bought the 30-year when it was yielding 1%, it went all the way up to 5.5 after the Fed's hikes at terminal rate. All of a sudden, your Treasury just got a massive impairment on it, right? Its price is worth way less. You can't do that with Bitcoin because there's no central entity to manipulate its monetary policy. Then you look at the other massive form of collateral, which is real estate. Real estate can be over leveraged, right? It can be packaged into things like collateralized debt obligations, these massive junk mortgage bonds, all these mortgages that were extended to people who didn't need them. And as a result, you get really bad collateral, or stocks, which again can be tied to corporate performance. And also they can be inflated away. You can create more units of them. But Bitcoin is different. Bitcoin is absolutely scarce. It's what I call a monetary constant, meaning that its value is determined by global liquidity conditions. It's not determined by individual market forces or auction schedule rejiggering or stock issuance or splits. And so that's why it's pristine collateral. And what it will do is it will fundamentally change the global financial system. It will fundamentally change the way that loans are written. It will change credit markets. As I mentioned, it will reduce this credit risk, right? In 2008, we had these cascading defaults because of collateral failure, right? All this over leveraged debt failed when these homeowners defaulted on these mortgages that they could never pay in the first place. Bitcoin eliminates that because it's fully verifiable and liquid. You could see where your Bitcoin is going at all times. You could see if your bank is rehypothecating your Bitcoin at all times. And if they are, you can go and withdraw it, right? And so banks who rehypothecate Bitcoin will fail, and they'll fail quickly. And that will teach a lesson to other banks who consider doing the same thing. In doing so, it's going to increase loan quality because lending against Bitcoin means that banks will be holding and appreciating high quality collateral base instead of assets that degrade over time. And so the main consideration for banks will be the Bitcoin hurdle rate, this 30% 4-year compound annual growth rate. Can this loan that I'm writing yield me 30% annually? If it can't, I'm going to reconsider writing this loan. And so it's going to increase loan quality. Ultimately, it's also going to mean lower interest rates for borrowers. So as Bitcoin becomes more widely used, as its liquidity expand, competitions among banks will rise. And those two factors will drive borrowing costs down. It will increase credit availability while maintaining loan integrity because of exactly what I mentioned. You'll be able to observe where your Bitcoin is going, and banks will also think twice about lending against an asset they're holding that's already appreciating at 30% a year. And the biggest thing, and the perhaps one of the largest ways that it's superior to something like U.S. real estate and U.S. Treasuries as a form of collateral is that it will improve capital efficiency, right? It's 24/7, 365. And traditional collateral, right? Particularly real estate and also corporate bonds, less so U.S. Treasuries, require really excessive over-collateralization to account for the risk associated with those loans and associated with collateral, with those collateral types. But Bitcoin's instantaneous liquidity, right? And it's expanding size. It's now close to $2 trillion asset, and it's transparent ownership. All these Bitcoin attributes mean that it will allow for higher loan to value ratios while still maintaining credit quality, right? You will be able to extend larger loans against the same value of Bitcoin without putting yourself at massive risk. And so, this means better mortgage terms, housing affordability, more accessible business credit for entrepreneurs. And ultimately, like for you and I, it makes for a financial system that rewards savings rather than punishing it through inflation and debt dilution and forcing people to borrow when they can't afford to in order to make ends meet. By banks holding Bitcoin, it will mean that the amount of credit that's being extended will be lower and it will be higher quality. And people will need fewer loans And the loans that they do get, because they're holding Bitcoin, and the loans that they do get will be much higher quality and for something that's actually worthwhile. And so Bitcoin is now stepping into that role. It was sidelined for years because of arbitrary regulatory constraints, because people were afraid of it. These banksters and these people who were funded by the banksters, like Elizabeth Warren, my own state senator, were afraid of what it would do to their system, right? They were afraid of what it would do to their paychecks. And now SAB 121 is gone, right? We have a president in the White House who isn't looking to enrich himself. He's already a billionaire. And so as a result of that, all of these things that prevented Bitcoin's integration into the financial system, this financialization of Bitcoin, all these things that prevented Bitcoin from fulfilling its role as pristine collateral have been taken away. So now Bitcoin can finally be held by these banks. It can serve as a better collateral, or it can serve as collateral, right, for loans. And banks will ultimately find that they prefer lending against Bitcoin over US Treasuries, over real estate, over corporate bonds, and the like.
We have maybe a few minutes left. I do want to point out, which I think this is awesome. I had 11 questions written down. I got to one of them. So I hope you'll consider being a friend of the show and coming back from time to time. Can you tell people briefly kind of what you're up to these days and where everybody can find you online?
Absolutely. Well, I'm happy I could give extended answers. I'm apologetic we couldn't get to all of them, but I'm happy to come back and chat with you more. This was really fun. So these days I'm working on Theya. You could probably tell by the big neon sign behind me over my left shoulder. It is a Bitcoin self-custody solution. Basically, the aim of Theya is to make it easier to take your Bitcoin off exchanges. Historically, using a hardware wallet by yourself, and also because a hardware wallet represents a single point of failure. What happens if I lose it? What happens if I lose the seed phrase that I write down? That's been really scary for a lot of people. And so they've kept their Bitcoin on exchanges, which is always risky. We saw what happened with FTX. We saw what happened with Celsius and BlockFi and everything else. And who knows what's happening with Coinbase, right? Who knows what they're holding on their balance sheet? Who knows what they're lending out? There's no transparency. And so what we wanted to do is basically make a really user-friendly way to take your Bitcoin off exchanges into a multi-sig self-custody solution. Self-custody is scary in and of itself. Multi-sig is even scarier. What we've done is we've packaged multi-sig self-custody for Bitcoin into a really user-friendly retail app that feels like it was made by Apple, right? We have one of the best designers in all of Silicon Valley who has built this for us and is continuing to work in it with us. We have engineers who are ex-PayPal, ex-Google, ex-Robinhood, right? People who have worked, in these digital financial systems for years who are building this. And we've had insane user feedback. We've had fantastic user feedback. And so if you are looking to get your Bitcoin off exchanges and eliminate single points of failure in your setup, like you're asking yourself, I have a lot of Bitcoin, this is scary, what happens if I pass away? Or you just want to make it so that you're not susceptible to something like a $5 rent attack where somebody invades your home or attacks you on the street and tells you to give up your Bitcoin. If you want to eliminate those risks and distribute your Bitcoin across multiple points of failure, fully self-custodially, check out Theya. You can look at it at theya.us. We've also built out this same solution for advisors and businesses. So if you're looking to create a business treasury and you want to custody all of the keys for that, we've built that out now. You can go to business.theya.us or just go to theya.us. All of these tabs are listed at the top. If you're looking to create a Bitcoin treasury, we are the best bespoke one-on-one solution to do that self-custodially. And we've also built out a solution for financial advisors who have clients who want to custody Bitcoin, or their financial advisors who want to help their clients begin custodying Bitcoin. We basically created a dashboard that allows advisors to onboard clients, and they hold one key. Their client holds one key, and then Theya holds a third key for recovery purposes. So we've built out all three of those products for normal individuals, for businesses, for advisors. All those are live on theya.us. And the most exciting thing that we're building, and this is the last thing I'll say, is Horizon. Horizon is basically a product we're creating to diversify your home equity into Bitcoin. And so if you're an individual that owns a home, that has a mortgage balance, that's sitting on some equity, we can actually help you diversify a portion of that into Bitcoin with no payments, no monthly interest charges, no monthly payments whatsoever. And it's basically a way for juicing your home returns from 4% a year, if you're living, in a normal suburban area, to 10 to 15 to 20% a year, right? If you diversify a prudent portion of that into Bitcoin. We're building that now. We're going to launch in a couple of weeks. And if you want to join the waitlist to learn a little bit more about it, and see if you qualify, you can go to joinhorizon.com. But those are the two things I'm working on now. Extremely exciting times, especially with SAB 121 repealed. I'm really excited to get Horizon off the ground. But yeah, no, those are the two things I'm working on today.
Awesome. Well, thanks so much for the time. Thanks for joining us, and we'll see you soon.
Thanks, Tim.